Hi everyone, I'm Jeff Hirsch. I'm here with my friend Carley Garner. She's at dcarleytrading.com and lots of experience with futures and options. And right now I want you to tell me your inexpensive hedge for a traditional stock portfolio. You have a great technique to do that.
So most people kind of overlook the fact that the futures markets were created to hedge risk. Most people go there to speculate, but there is a way that you can there is a way you can hedge your stock portfolio. So if you're holding a portfolio that is relatively closely allocated to the S&P 500 stocks, you can use the futures and options on futures market to do that.
Which future are you looking at to do
So specifically the emini S&P futures contract and the emini S&P options that are written against that futures contract. So what we like
we're talking options on futures contracts to hedge against the traditional stock portfolio.
Yes, exactly. And the reason you might want to do it with using options on futures as opposed to stock options, like maybe SPX options, that sort of thing, is you get more leverage, you get more bang for your buck, the margins are lower, you can do it with a smaller account size, so you're not going to tie up as much.
So the OEX options cost a lot more than an option on an E-mini.
They tend to be, brokerage firms tend to require more money to sell options on those products and things like that. So in the futures markets, like for example, most stockbrokers want to see $50,000 to $100,000 in an account before you even consider selling options. And so, but someone
index options,
so someone in the futures market could do something like that with $5,000 to $10,000, and you know that money is
lower margin requirements for futures.
So it's a lot more efficient. Also, the futures markets trade roughly 24 hours a day, so you can put your hedge on or take it off around the clock, whereas in the stock market you're waiting for the New York Stock Exchange to open, and that can be stressful if something happened overnight.
So, down to the nitty-gritty. What's the trade? What are you putting on for this hedge?
Okay, so the idea is you want to do it on a stock market upswing. You don't want to do it when the market's in the trough, but when it's on an upswing, when everyone else is thinking about making money in their portfolio, not hedging risk, that's when you should do it.
Contrary thinking there.
Exactly. So the idea is you want to sell an E-mini S&P call option and then use the money that you collect for that to buy a put option. So in essence what you're doing...
But you're selling the call with a strike above
the market.
Well above.
As above as you can get. I mean, it depends. If you're doing it on an upswing, you might be able to sell it 1.5% to 3% out of the money, meaning you're still giving yourself, your portfolio, that 1.5% to 3% in leeway to move higher. And then above the strike price of the short call, you are capping your profit potential, so you have to keep that in mind. That's the opportunity cost. But the money that you collect for that call option can be used to purchase a put option underneath. And the put option acts as a floor to your portfolio, so it's protecting the downside risk under a certain amount. So it's free insurance in regards to the cash outflow, because the money you're collecting on the short call...
So you want to make sure that the amount that you're selling your call for equals the amount that you're buying your put for.
That's what you want.
Or close.
Close, yeah. So it's free insurance. The opportunity cost is you're giving the upside potential on your, you're capping your upside potential on your portfolio.
This sounds like it would work really well at the end of the best 6 months for our seasonal switching strategy.
Yeah, exactly. Do it when the market's hot is when you want to do something like that.
When you get my MACD sell signal, you put on this hedge.
There you go. That might be
That's cool. Really cool. All right. Thank you, Carley. Thank you, everybody.